All right, let's dive into this explainer and decode a massive transition currently shaking the very foundation of our global economy. We're looking at how the entire financial system is violently shifting from an era of synchronized monetary abundance, where money was basically cheap and easy to find everywhere, straight into a period of fragmented geopolitical scarcity. We're calling this the Warsh Washout. We're mapping an incredibly complex macroeconomic domino effect today, so here is our roadmap. First, welcome to the Warsh Washout. Second, global central bank divergence. Third, the yen carry trade unwind. Fourth, hidden shadow banking risks. And finally, the strategic corporate playbook. Welcome to the Warsh Washout. We're starting right at the epicenter of this financial earthquake, the installation of Kevin Warsh as the new Federal Reserve Chair. When Warsh took over, there was a massive collision between expectation and reality. Wall Street made huge bets on what they called the Warsh Trade. Markets aggressively priced in a dovish, politically driven pivot, assuming the new Fed chair would deliver rapid, deep interest rate cuts. But that trade aggressively collapsed into the Warsh Washout. The harsh reality is a hawkish bind. Core PCE inflation, the metric that strips out volatile stuff like food and energy, remains stubbornly stuck at 2.8%. And with upstream pressures like freight and diesel surging, the Fed is locked into rigidly holding its policy rate at 3.75%. Economic realities absolutely crush the political narrative. If you look at the resulting chaos across the U.S. Treasury curve, you see a massive bear steepening, meaning long-term rates are rising much faster than short-term ones. The 2-year spiked to 4.07%, the 10-year hit 4.59%, and the 30-year breached 5.12%. This screams deep-seated inflation anxiety. The market finally gets it. Under Warsh's classical monetarist philosophy, the Fed put is definitively dead. The central bank will not just swoop in to save the day with rate cuts at the first sign of market volatility. Let's just pause on that 30-year Treasury figure for a second. 5.12%. Hearing that staggering number should wake us all up to the era of absolute fiscal dominance. Total U.S. federal public debt has crossed 100% of GDP, and net interest payments literally exceed the entire U.S. national defense budget. When a recent $25 billion 30-year bond auction cleared above 5% for the first time since 2007, it sent a clear message. The bond market is becoming hypersensitive to the erosion of fiscal credibility.
Moving on to part 2, global central bank divergence. Let's look at our next domino and see how this builds, because this localized U.S. pressure is fracturing the entire global system.
For the first time in years, the world's major central banks are operating completely out of sync. You've got the Federal Reserve stuck holding at 3.75% due to sticky stagflation risks. But over in Europe, the European Central Bank is actually reversing their planned cuts because of a severe energy shock. Over in Tokyo, the Bank of Japan is hiking rates due to a historic wage price spiral, ending decades of zero-interest policy. Meanwhile, completely isolated from this inflation dynamic, the People's Bank of China is aggressively cutting rates to fight off deflation and a property contraction. Localized crises are forcing every central bank to drastically ration capital based on their own unique constraints. So what exactly forced that sudden reversal in Europe? It was a massive exogenous geopolitical shock. The closure of the Strait of Hormuz stranded 10 million barrels of oil daily. This specific disruption shoved Brent crude well past $100 a barrel. Since Europe and the UK are incredibly heavy energy importers, this acts as a huge, unavoidable regressive tax on their economies, instantly paralyzing their central banks with the threat of stagflation. Which brings us to part 3, the yen carry trade unwind. As we track these macroeconomic shockwaves globally, we inevitably land in Tokyo. The Bank of Japan's move to normalize interest rates is actively breaking down one of the largest structural trades in financial history. Let's break down the notoriously tricky mechanics of this yen carry trade. For decades, investors borrowed Japanese yen at near zero interest rates and then used it to buy high-yielding U.S. risk assets, like tech stocks or treasuries. It was easy money. But now, the Bank of Japan is hiking rates, borrowing is more expensive, and the yen is strengthening. This triggers massive margin calls for highly leveraged funds. To cover those calls, they can't just sell off their illiquid assets. They're forced to indiscriminately dump their best-performing U.S. assets just to raise cash immediately. To really grasp the sheer, terrifying scale of this unwind, get this. Japanese investors dumped $30 billion worth of U.S. treasuries in just the first quarter alone. They're forcefully exporting their domestic volatility straight into Western markets. U.S. equity investors have effectively been free riders on Japanese monetary policy for decades, and that free ride is coming to a very abrupt, painful end. That flows directly into Part 4, Hidden Shadow Banking Risks. This massive extraction of global liquidity hits the structural weak points in our financial plumbing. Since the 2008 financial crisis, traditional retail banks have been heavily regulated. But systemic risk didn't disappear. It just changed addresses. It migrated right outside the regulatory perimeter into a staggering $256 trillion non-bank financial intermediation sector. We're talking asset managers, hedge funds, clearinghouses, the shadow banking system. So how exactly does a $256 trillion shadow system actually break? Think of it like the plumbing in your house. You honestly never think about it until a pipe bursts and floods your living room. Systemic risk today isn't about traditional bank runs with lines of people waiting outside to withdraw physical cash. It's about market plumbing. It's defined by sudden, instantaneous, algorithmic disruptions in incredibly obscure operational mechanisms, margin rules, repo markets, and collateral practices. Let's walk through the timeline of how a modern, market-based run actually unfolds. At T0, you get a volatile shock, like the yen carry trade unwind or an energy spike. Within just one day, clearinghouses automatically crank up their margin requirements to protect themselves. By day 2, non-bank funds are scrambling for cash, forced to indiscriminately sell off assets. This tanks asset prices even further, which triggers even larger margin calls. By day 3, you're trapped in a reflexive, deleveraging doom loop of forced selling when cash is systemically scarce. And ultimately, this immense stress falls right back onto the regulated banks that act as the middlemen for this entire system. Finally, let's get practical with Part 5, the strategic corporate playbook. With synchronized liquidity dead, global central banks fracturing, and shadow banking vulnerabilities totally exposed, what do we actually do? You have to look for localized opportunities born from this chaos. A fascinating real-world example is how the city of Osaka is aggressively capitalizing on the yen carry trade unwind. Knowing that immense pools of Japanese capital are heading home, Osaka launched Phase 2 of their global financial strategy. They are offering massive incentives, including an unprecedented 0% corporate tax for foreign financial firms for up to 10 years. They're actively building an entirely new Asian financial hub to act as an intermediary for this capital precisely as global liquidity dynamics shift. For the corporate allocators and CFOs tuning into this explainer, passive management is now a recipe for absolute disaster. You must rapidly implement 3 structural guardrails to achieve total liquidity self-sufficiency. Number 1, enforce strict duration discipline. You want to avoid locking in long-term fixed liabilities when the ultra-long end of the curve is staring at a 5% floor. Number 2, build shock-resilient supply chains. Upstream inflation is structural now, so you must aggressively hedge your freight and diesel inputs immediately. And finally, number 3, insulate your treasury operations from those shadow banking risks we just discussed. Ensure your operating liquidity is locked safely within Tier 1 institutions backed by direct central bank reserve access. The era of cheap, synchronized money is completely over. Geopolitical risk is no longer some abstract tail event. It is a mathematical premium directly embedded into the price of sovereign debt, energy, and capital itself. As we wrap up this explainer, I'll leave you to reflect on your own financial resilience against these irreversible macroeconomic shifts. The rules of the game have changed, so are you prepared for a permanent capital premium?